Hi guys! Enjoy John's analysis.
99.5%. That is not a typo, and it is not a rounding error. On March 2nd, 2026, the day Arthur Hayes published the most important essay he has ever written, the derivatives market was pricing a 99.5% probability that the Federal Reserve would not cut rates at any meeting for the remainder of the year. Coin Bureau posted the screenshot publicly. The market had spoken with the closest thing to certainty that financial markets ever produce. And Arthur Hayes looked at that number and said, that is exactly what the market said before every single one of the last 4 times the Fed pivoted. And you know what happened next. Hayes published an essay titled iOS Warfare on his Substack that same day. He is the co-founder of BitMEX, one of the most important Bitcoin derivatives exchanges ever built, and the current chief investment officer of Maelstrom, a crypto investment fund. He built his reputation over a decade by linking Bitcoin's price not to halving cycles or retail sentiment or Twitter momentum, but to one variable above all others: the cost and availability of money in the global financial system. His core thesis, stated across dozens of essays and hundreds of hours of interviews, compresses into 5 words. Money printing is good for Bitcoin. The iOS Warfare essay argues that the Iran war, which began on February 28th with the US-Israeli Operation Epic Fury, has just triggered a historical sequence that ends in money printing, and therefore ends in Bitcoin. This channel does not give price targets. This channel does not endorse Arthur Hayes. This channel has done the work of verifying every single claim in this essay against primary sources: Federal Reserve transcripts, FOMC statements, the New York Fed's own operating policies, academic research on the MOVE Index, and the documented record of Hayes' prediction history, including his failures. What this channel found is more interesting than either pure validation or pure refutation. What this channel found is a framework that deserves serious, rigorous examination. A framework built on 40 years of documented Federal Reserve behavior, a framework with a specific and watchable trigger, and a framework whose bear case is as important as its bull case. This video will give you both. You are going to understand the architecture of the argument before you make any decision about what to do with it. Arthur Hayes is not a comfortable personality for mainstream financial media. He co-founded BitMEX in 2014, built it into the world's dominant Bitcoin derivatives exchange, and stepped down in 2020 after the US Department of Justice indicted him on Bank Secrecy Act violations, charges to which he eventually pleaded guilty and paid a $6 million fine. He is polarizing, frequently confrontational, and operates with a level of intellectual aggression that produces both brilliant macro analysis and spectacular prediction failures in roughly equal measure. Protos, the crypto journalism outlet, published a methodical analysis of 20 of Hayes' market calls and found he failed in 16 of them. This channel will not hide that record. It is part of the evidence you need to evaluate this framework honestly. The failures are documented and significant. In December of 2025, Hayes predicted Bitcoin would reach $200,000 by March of 2026, citing what he described as hidden liquidity injections through the Federal Reserve's new Reserve Management Purchases program. Bitcoin was trading at approximately $68,000 as of April 2nd, 2026, roughly 46% below its October 2025 all-time high of $126,000 and approximately 66% below the $200,000 target.
Hey guys, I need a quick favor from you. If you're enjoying this video, please smash that like button and hit the hype button after. It really helps the channel grow and tells the algorithm that this kind of deep macro plus Bitcoin content deserves to reach more people. Takes literally 2 seconds, but makes a huge difference for us. See you.
In his January 26th, 2025 essay, Hayes predicted crypto markets would peak in mid-March 2025. The actual peak in total crypto market cap occurred on January 20th, the day of Trump's inauguration, and by March, the total crypto market cap was more than $500 billion lower. In September of 2024, Hayes predicted Bitcoin would drop below $50,000 and admitted to shorting it, according to Protos' documentation. Bitcoin never traded below $50,000 after that date. These failures matter not to dismiss Hayes, but to frame what kind of thinker he is. Hayes is a macro-directional analyst with a consistent underlying thesis and inconsistent timing. He identified the Fed's pivot before most market participants in multiple cycles. His thesis about global liquidity being the dominant driver of Bitcoin's price has been validated by independent academic research, showing a 0.94 correlation between Bitcoin and global M2 money supply from 2013 to 2024, documented by Flipster and multiple quantitative analysts. The research from BGMetrics and BM Pro demonstrates a consistent lag of approximately 10 weeks, roughly 60 to 70 days, between global liquidity expansion and Bitcoin price response, which means Hayes' directional calls are frequently correct. and his timing calls are frequently wrong. Understanding this distinction is the entire key to evaluating iOS warfare. The essay itself is constructed around a specific and falsifiable historical claim. Hayes examined every major U.S. military operation in the Middle East from 1985 to the present and documented what the Federal Reserve did with interest rates in the aftermath of each one. He pulled directly from Federal Open Market Committee statements, primary source government documents, rather than relying on secondary narratives. The Substack essay quotes the FOMC transcripts verbatim, and this channel verified those quotes against the historical record. The pattern Hayes documents is not ambiguous, it is not cherry-picked from 2 data points, and it is not a coincidence that one analyst constructed after the fact to fit a thesis. It is a 40-year documented pattern of Federal Reserve behavior that has repeated across 4 presidential administrations, through inflation spikes and growth slowdowns under both Republican and Democratic leadership, and in the full knowledge of every subsequent Fed chairman who inherited the precedent from his predecessor. The iOS warfare thesis, reduced to its most precise statement, is this: the United States has initiated its most expensive and geopolitically significant Middle Eastern military operation since the 2003 Iraq invasion. Based on 4 decades of documented precedent, that means the Federal Reserve will eventually ease monetary policy to help finance the war and stabilize an economy shocked by the energy price spike that follows it. Bitcoin, which has a documented 0.94 correlation with global liquidity over the past decade, will respond to that easing with a price move that reflects the magnitude of the liquidity expansion. The essay does not claim this happens immediately. The essay does not claim it happens in a straight line. The essay says, and this channel verified the exact phrasing, I don't think there are going to be many more years where you can buy sub $100,000 Bitcoin. On the March 9th Coin Stories podcast, Hayes stated with unusual candor, if he had $1 to invest right now, he would not put it into Bitcoin. He would wait for the Federal Reserve to confirm the pivot before sizing up. This is a man who has never been known for patience or caution in Bitcoin. That context makes the restraint more notable than the target. The year was 1990. Saddam Hussein had invaded Kuwait in August, and by the time the coalition forces launched Operation Desert Storm in January 1991, oil prices had already spiked dramatically, and inflation concerns had complicated Federal Reserve policymaking for months. Hayes quotes directly from FOMC statements of that period in his iOS warfare essay, and this channel verified those quotes against the historical record. The FOMC minutes from late 1990 read as follows: the heightened uncertainties and the prospectively less satisfactory performance of the economy stemming from events in the Middle East had greatly complicated the formulation of an effective monetary policy. The Fed held rates steady at its first meeting after the invasion. Then, at its November and December 1990 meetings, the Federal Reserve cut rates, citing the war, euphemistically described as events in the Middle East, as a complicating factor in achieving its dual mandate of price stability and maximum employment. The Federal Reserve eased in the face of oil-driven inflation. That is not how the standard model says central banks should behave during inflationary supply shocks. They did it anyway. The year was 2001. The World Trade Center towers fell on September 11th, and within days, Alan Greenspan was in front of an emergency FOMC session where he reportedly stated, Hayes quotes this directly in iOS warfare, at a minimum 50 basis points. The Fed cut rates by 50 basis points in an emergency unscheduled action immediately following the attacks, and then continued cutting aggressively through the subsequent conflicts in Afghanistan and Iraq. By the time the global war on terror was in full swing, the federal funds rate had fallen from 6.5% in January 2001 to 1% by June 2003. A 5.5 percentage point easing cycle executed while inflation was a live concern, while the U.S. was running expanding fiscal deficits to fund military operations, and while oil prices were rising due to Middle Eastern instability. The Fed eased. Hayes documents a specific FOMC statement from this period that this channel independently verified. Although the necessary reallocation of resources to enhance security may restrain advances in productivity for a time, the long-term prospects for productivity growth and the economy remain favorable. The Fed was managing the political economy of war, not just the technical economics of inflation. That distinction is central to Hayes' thesis. The year was 2009. Barack Obama, who had won the Nobel Peace Prize in October, was simultaneously executing what military historians call the surge, a significant escalation of U.S. troop presence in Afghanistan, and the Federal Reserve was running what was then the most aggressive monetary expansion in American history. 0 interest rates, 2 rounds of quantitative easing, and a Fed balance sheet that grew from approximately $900 billion before the financial crisis to over $2 trillion by the end of Obama's first year. Hayes acknowledges in iOS Warfare that the primary driver of Fed easing in 2009 was the financial crisis, not the Afghanistan surge, and that there was limited additional rate cutting room because rates were already at the 0 lower bound. He uses this example not to claim the war caused QE, but to document that the Fed conducted radical monetary expansion simultaneously with an active military escalation, and that the two were not treated as incompatible. The institutional reflex is not just historical pattern. It is a documented feature of how the Federal Reserve has weighed its dual mandate responsibilities against the fiscal and geopolitical realities of wartime America. The pattern across all 4 precedents that Hayes identifies, the Gulf War, the global war on terror, the Iraq surge, and the Afghanistan surge, is not that war mechanically triggers rate cuts. The pattern is more specific and more important than that. Every major U.S. military operation in the Middle East since 1985 has been followed by a Federal Reserve that eased policy faster than it otherwise would have, citing the economic uncertainty created by the conflict as justification for reducing the cost of money. The mechanism is political economic, not purely technical. When America is at war, fiscal deficits expand dramatically. Borrowing costs matter more to national solvency, and the political pressure on the Fed to facilitate government financing without triggering a bond market crisis becomes acute. The interest cost on $39 trillion in U.S. national debt at current rates is approximately $1 trillion per year, a figure confirmed by the Congressional Budget Office, the American Action Forum, and multiple other sources this channel has verified in prior videos. Adding the fiscal cost of Operation Epic Fury to a government already spending more on interest than on defense is not a pressure the Treasury can absorb indefinitely without the Federal Reserve's cooperation. The bear case on this historical analysis must be stated with equal precision, because any investor who uses this framework without understanding its limits is using it wrong. The Iran War of 2026 is structurally different from the 4 precedents Hayes cites in one critical dimension: inflation. The 1990 Gulf War ended in 4 months, and the oil shock was relatively brief. The post-September 11th environment was deflationary, not inflationary. The Fed eased into a collapsing economy, not a hot one. The 2009 surge happened with the federal funds rate already at 0 and the Fed already executing QE. None of those episodes confronted the Federal Reserve with the specific dilemma it faces in April 2026, a stagflationary shock, simultaneous inflationary pressure from oil and recessionary pressure from the war's impact on growth, in a context where the Fed has already cut rates 3 times in the previous 14 months, and inflation remains above its 2% target. Jerome Powell said at his March 18, 2026 press conference, confirmed by CNN, CBS, and the New York Times, that he would reserve the term stagflation for a much more serious set of circumstances. He also said twice that the Fed was not making as much progress on inflation as hoped. The range of possibilities, he acknowledged, certainly includes no rate cuts in 2026. Morningstar's analysis of the press conference quoted Oxford economics chief U.S. economist Michael Pierce, describing the Iran war as a stagflationary shock that simultaneously weakens growth and stokes inflation, precisely the scenario where the Fed's standard playbook of cutting to support growth conflicts directly with its mandate to control inflation. Before we analyze the ghost of Paul Volcker and the indicator that triggers the machine, I want to see who is awake with me. The Federal Reserve's decisions ripple across every time zone, and I want to see our community's footprint right now. Drop a comment below. Tell me your city, your exact local time, and the weather outside your window. Is it a cold morning in London, high noon in Singapore? Or are the lights still on in Miami, Austin, or New York? Let's see the community that doesn't wait for the morning news to understand the truth of the markets. And if you believe that access to this level of financial signal is a right, hit the like button and subscribe right now. It is the only way we signal to the algorithm that we want signal, not noise. Now, let's look at the ultimate bear case. Before Hayes can build his liquidity thesis into a Bitcoin trade, he needs a trigger. He is not making a claim that money printing has started or that the Fed pivot is imminent. He's making a claim about what sequence of events will force the Fed to print. And he has identified a specific, publicly available, daily updated instrument that tracks the proximity of that force. It is called the MOVE Index. It was created in 1988 by Merrill Lynch, now maintained by ICE, and its full name is the Merrill Lynch Option Volatility Estimate Index. Charles Schwab describes it as the VIX of bonds. It measures the implied volatility of U.S. Treasury options across the 2-year, 5-year, 10-year, and 30-year maturities using a weighted average model. In plain terms, it tells you how much the bond market expects Treasury yields to swing in the next 30 days. When this number is below 80, the bond market is calm and the Fed is in control. When it rises above 100, something is cracking in the world's most important market. When it exceeds 150, central banks have historically intervened. Hayes explained the mechanism in a tweet posted on March 5, 2026, verified by Crypto.news, CoinCentral, and multiple other outlets, in which he wrote, "If Brent oil keeps ripping due to US-Iran war, 10-year yields might spike in a volatile way, forcing MOVE index higher, and that is a prereq for a money printing bailout. Still early doors, but something to watch." The chain of causation he is describing has 5 links. Link 1. The Strait of Hormuz remains closed or disrupted, keeping Brent crude above $100 per barrel. Link 2. Elevated oil prices feed inflation expectations, pushing Treasury investors to demand higher yields as compensation for holding bonds whose purchasing power is being eroded. Link 3. Rising Treasury yields combined with a U.S. Treasury that needs to issue massive new debt to finance the war creates a bond market liquidity problem. Too much supply, not enough demand, at affordable prices. Link 4. The MOVE index, measuring Treasury volatility, rises above the level where the Federal Reserve's tolerance for dysfunction is exceeded. Link 5. The Fed or the Treasury Secretary intervenes with liquidity through rate cuts, through explicit QE, or through the Reserve Management Purchases mechanism that Hayes has been documenting since December 2025. Each of these links is individually verifiable against current market data. On March 27, 2026, Arthur Hayes posted on StockTwits that the MOVE index had hit 115, a level confirmed in the StockTwits article by the platform's own coverage team. He described this as quantitative easing being almost there. In his iOS warfare essay, Hayes specified that a MOVE reading above 140 would likely force Treasury Secretary Scott Bessent into deploying bond market stabilization tools, buybacks, direct liquidity support, or indirect support through Fed coordination. The MOVE Index historical record documented by Access.com and Charles Schwab shows the following crisis levels. Above 250 in the 2008 financial crisis, approximately 170 during the COVID crash in March 2020, and approximately 200 during the regional banking crisis in March 2023. In each of those episodes, Federal Reserve intervention followed within days or weeks of the extreme MOVE reading. The current level of approximately 115 as of late March 2026, while well below crisis thresholds, is in the range that Hayes describes as the setup phase, not the trigger phase. The direction of travel matters more than the absolute level. The MOVE index mechanism works because the U.S. Treasury market is the foundational plumbing of global finance. When that market becomes too volatile, when Treasury yields are swinging by multiple basis points per day, and bond investors cannot price risk with confidence, every other market breaks simultaneously. Equity margins are called. Corporate credit spreads widen. Dollar funding markets seize. The Federal Reserve has a legal mandate to maintain functioning financial markets, and every Federal Reserve chair since Paul Volcker has demonstrated that in a genuine bond market crisis, that mandate overrides every other consideration, including the inflation target. This is not a theoretical claim. Hayes documents it with 4 decades of FOMC statements. Wolf Street, the respected financial blog that published the most detailed counter-analysis of Hayes' RMP thesis this channel found, acknowledges this fundamental point even while disagreeing with Hayes on whether the current RMP program constitutes QE. The counterfactual, a Federal Reserve that allows a Treasury market dysfunction to persist until it produces a sovereign debt crisis, has no historical precedent in the modern era. The current state of the MOVE index as of early April 2026 is elevated but not extreme. The New York Federal Reserve's Liberty Street Economics blog published an analysis on April 2nd of this year, documenting that Treasury market liquidity had steadily improved throughout 2025 from the volatility seen during the April 2nd, 2025 tariff announcement, reaching its best level since 2021 in early 2026. That improvement, the NY Fed analysts noted, has now reversed. Economic uncertainty and interest rate volatility have increased since the end of our sample period, given the conflict with Iran and its repercussions, underlining the view that Treasury market liquidity warrants continued close watching. The Federal Reserve's own economists are watching the same metric Hayes is watching. They are watching it from opposite sides of the same market, with opposite preferences for what they want to see, but they are watching the same clock. Okay, quick disclaimer. The macroeconomic and geopolitical analysis in this video is strictly for educational purposes and does not constitute financial advice. Trading and investing in Bitcoin and commodities during times of war involves extreme volatility and the risk of total capital loss. Therefore, you must prioritize strict risk management disciplined position sizing, and your own due diligence, DYOR, before making any investment. These models are probabilistic, not guaranteed, and you are solely responsible for your financial decisions and the consequences of your trades. Stay sharp, use stop losses, and never invest capital you cannot afford to lose. Now let's continue. On December 10th, 2025, Jerome Powell stood at the Federal Reserve's post-FOMC press conference and announced two things simultaneously. The first was a 25 basis point rate cut, bringing the federal funds rate to a target range of 3.5 to 3.75%. The second was the launch of what the Fed called reserve management purchases, a program through which the New York Federal Reserve would purchase approximately $40 billion in short-term Treasury bills per month from the secondary market, starting December 12th. Powell described this as solely for the purpose of maintaining an ample supply of reserves, and said explicitly that it was separate from the stance of monetary policy. Wolf Street published a detailed technical analysis explaining why RMP is structurally different from quantitative easing. RMP targets short-term T-bills rather than long-duration treasuries, has minimal impact on the yield curve, and is designed to prevent repo market disruptions around tax payment dates rather than to stimulate the broader economy. The New York Fed's official policy statement, which this channel read in its entirety from the primary source, confirms Powell's description. Arthur Hayes read the same announcement and reached the opposite conclusion. In his December 19th essay titled Love Language, published on his Substack and reported by Cointelegraph, MEXC, and Coin Tribune, Hayes argued that the RMP program is a thinly disguised way for the Fed to cash the government's checks, and described it as highly inflationary from both a financial and real goods services perspective. His specific technical claim is that the program has no explicit size limit, that New York Fed President John Williams has discretionary authority to expand it through the vague ample reserves guidance, and that the mechanism by which it expands the balance sheet, even if it does so through short-term instruments rather than long-duration bonds, is functionally equivalent to QE in its effect on overall system liquidity. He quoted himself as saying in his characteristically unfiltered style, "I love quantitative easing because it means money printing, and thankfully, I own financial assets like gold, mining stocks, and Bitcoin that rise faster than the pace of fiat devaluation." The man is not subtle about his interests in the outcome. The debate between Hayes and Wolf Street on whether RMP is QE is a genuine technical dispute among sophisticated market observers, and this channel is not qualified to adjudicate it definitively. What this channel can do is present both sides accurately. Wolf Street argues that QE's power comes specifically from its announcement effect. The Fed standing at a podium touting a multi-trillion-dollar balance sheet expansion to maximize the psychological impact on financial conditions, and that RMP, introduced as a low-key technical footnote, has no such effect. Wolf Street also argues that purchasing short-term T-bills rather than long-duration bonds does not compress yields at the 10-year maturity that matters for mortgages, corporate borrowing, and growth investment. LPL Research's fixed income outlook for 2026 agrees with Wolf Street, describing RMP as not QE, and noting its minimal impact on the yield curve. Hayes counters that the distinction between QE and RMP is political, not functional, that the Fed has simply rebranded balance sheet expansion to avoid the toxic political associations that QE developed during and after the pandemic. Both analyses are published, both are authored by credible market observers, and both deserve your consideration. What is not disputed is the basic fact. The Federal Reserve was purchasing $40 billion per month in U.S. government securities as of December 2025, and that program was ongoing through early 2026, before any wartime fiscal pressure was added to the system. Now add the war. Operation Epic Fury began on February 28, 2026. The U.S. was already running a $1.9 trillion projected deficit for fiscal year 2026 before the first strike was launched, according to the Congressional Budget Office analysis documented by the Independent Institute. Every week that the conflict continues adds military expenditures, veteran care commitments, and economic disruption costs to a fiscal position that was already on an unsustainable trajectory. The Powell Federal Reserve acknowledged at its March 18th meeting, documented by CNN, PBS, CNBC, The Street, and Newsweek, all of which this channel reviewed in their entirety, that the implications of the Iran conflict for the U.S. economy are uncertain, and that the Fed cannot currently commit to any rate cut in 2026. Polymarket traders were pricing a 34% probability of zero cuts in 2026 as of late March, up from 10% before the war began. Markets were pricing zero cuts. Powell would not commit to one cut. The Fed's dot plot showed one cut, but Powell said explicitly, "If we don't see progress on inflation, you won't see the rate cut." The official Fed position as of April 2026 is, we may cut once, we may cut zero, we will not cut until we see meaningful inflation progress that the war is currently preventing us from seeing. Hayes looks at the situation and sees the setup for the fifth repetition of a 40-year pattern. The Federal Reserve is in a box. If the war extends, oil stays high, inflation stays elevated, and the Fed cannot cut rates. Fiscal deficits expand further to finance military operations. The bond market absorbs more Treasury issuance, yields rise, and the MOVE index climbs. At some threshold, Hayes identified 140 as his personal monitoring level in iOS warfare. The dysfunction in the Treasury market becomes severe enough that the political economic calculus changes. The cost of allowing the bond market to break exceeds the cost of appearing to validate inflation by injecting liquidity. The Fed chooses liquidity over inflation discipline. It has made that choice 4 times in the past 40 years. Hayes is betting it makes it a 5th time. This block is the quantitative foundation of the entire argument, and this channel will present it with the precision it deserves, rather than with the narrative enthusiasm it is easy to apply to correlation data. The relationship between Bitcoin's price and global M2 money supply, the aggregate measure of liquidity across the world's 21 major central banks, has been documented by multiple independent analysts and has been the subject of published quantitative research. Flipster's analysis, reviewing Bitcoin from 2013 through 2024, found a correlation coefficient of 0.94 between Bitcoin and global M2 over that period. Bitcoin Magazine's 3-signal analysis found an 88.44% correlation in the current cycle without any time offset, rising to 91.23% with a 70-day offset. BGeometrics and BM Pro independently identified a 10-week lag, approximately 60 to 70 days, as the period between global liquidity changes and Bitcoin price response, with the best fit correlation in the current cycle occurring at roughly 60 days. These are not cherry-picked data points from a single source. They represent a convergent finding across multiple independent research efforts using different methodologies and different time periods. What this data means for the Hayes thesis is precise and specific. If the Federal Reserve pivots through rate cuts, explicit QE expansion, or the activation of larger-scale Treasury market support mechanisms, the change in global liquidity that results from that pivot would, based on the historical 10-week lag, produce a Bitcoin price response approximately 60 to 70 days later. This is not a prediction of where Bitcoin goes. This is a description of how long the plumbing takes to move the water from the source to the tap. Sarson funds, in their analysis of the M2 Bitcoin correlation, concluded that Bitcoin tends to respond more aggressively to liquidity than traditional hedges like gold. It behaves as a higher beta asset that reflects the same forces but with greater volatility and upside potential. This means the same liquidity expansion that produces a modest rise in gold and equities can produce a disproportionately large Bitcoin move because Bitcoin has no yield, no earnings, no dividends, and no cash flow. Its entire fundamental value case rests on scarcity and the cost of alternatives, both of which are directly affected by the price and quantity of money. The bear case on this correlation is essential, and this channel states it plainly. Correlation is not causation, and the 0.94 figure spans a specific historical window that included the post-pandemic QE blowout and the extraordinary rate hiking cycle of 2022 to 2023, 2 of the most extreme monetary policy episodes in American history. In a more normal monetary environment, one where the Fed is cutting rates by 25 basis points at measured intervals rather than printing trillions, the Bitcoin M2 correlation has been demonstrably weaker. The Caleb and Brown analysis, reviewing Bitcoin cycle dynamics in the context of the 2024 halving, noted that, like other risk assets, Bitcoin has become correlated with the global M2 money supply, but also noted that the correlation is not perfect and that Bitcoin can be affected by internal crypto-specific events and its own halving cycle timing, causing short-term divergences from macro trends. The BM Pro Substack analysis added a specific caution relevant to the current environment. During Bitcoin's consolidation phase in early 2025, global M2 was steadily increasing, but its rate of change was flat. Only when M2's expansion accelerates noticeably can Bitcoin break out towards new highs. This means it is not enough for the Fed to cut rates once by 25 basis points, and for the M2 growth rate to tick up modestly. The correlation between M2 and Bitcoin is driven by rate of change, not absolute level, which means Hayes needs not just a pivot, but an acceleration. The current state of global liquidity as of early 2026 reflects the post-ATH compression that followed Bitcoin's October 2025 all-time high of $126,000. Global M2 had been expanding moderately through 2025, but the rate of change was insufficient to sustain Bitcoin's momentum after it reached peak price territory and began distributing. The Iran war created an additional headwind by introducing inflationary pressure that reduces the probability of rate cuts globally, not just in the US, but in Europe and Japan, where central banks face the same oil price transmission problem. Oxford Economics described the Iran shock as stagflationary in testimony covered by Morningstar, meaning it simultaneously raises prices and reduces growth, creating a central bank environment where easing is economically needed but politically impossible as long as inflation is rising. This is precisely the conditions under which Hayes says Bitcoin is a leveraged option on monetary policy rather than an immediate buy. His explicit instruction, stated on the March 9th Coin Stories podcast and verified by the Coin Republic and ABC Money, was to wait for confirmed central bank easing before sizing up Bitcoin exposure. Not to buy ahead of the pivot, to wait for the confirmed signal. Jerome Powell has at most 2 more press conferences. His term as Fed chair ends on May 15th, 2026, and the Senate confirmation process for his successor, Trump's nominee Kevin Warsh, a former Fed governor described by analysts as a monetary hawk, has been stalled by a Department of Justice investigation into the Fed's $2.5 billion building renovation. The Fortune article from March 16th confirmed that Senate confirmation hearings remain delayed. Powell told reporters at his March 18th press conference, confirmed by both The Street and CNBC, that he has no intention of leaving the board until the investigation is well and truly over with transparency and finality. The financial content analysis published April 2nd identified the Powell to Warsh transition as a particularly perilous moment, because any perceived misstep by a new Fed chair in a stagflationary environment could produce a loss of market confidence that the current chair's institutional credibility helps prevent. The leadership transition is itself a source of bond market volatility, and bond market volatility is what the MOVE index measures. Powell's specific problem at the March 18th meeting was documented with unusual candor in the press coverage. He is simultaneously facing inflation above target, a labor market that shed 92,000 jobs in February, oil prices near $110 per barrel, and zero political clearance to cut rates because the market and the White House both need to see credible inflation control. His exact words, quoted by CNBC, "The forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. The rate forecast is conditional on the performance of the economy, so if we don't see that progress, then you won't see the rate cut. This is a Fed chair telling the market explicitly that his own dot plot projection of 1 cut is contingent. Not committed, contingent." The Morningstar analysis of the meeting quoted Oxford Economics as saying, "The range of possibilities certainly includes no rate cuts in 2026. CME FedWatch was showing approximately 98% probability of a hold at the April 28th to 29th meeting, as of April 2nd, confirmed by financial content. Markets are not pricing a pivot. Markets are pricing permanent hold." Hayes' response to this information is not to revise his thesis, but to identify what would have to happen to force the Fed's hand. The mechanism he described in iOS warfare and elaborated in subsequent tweets is specific. Brent crude, sustained above $100, leads to persistent inflation above 3%, which leads to Treasury investors demanding higher yields to compensate for inflation erosion, which leads to rising 10-year yields, which leads to MOVE index above the intervention threshold, which leads to either the Fed or the Treasury responding with some form of liquidity support. The current 10-year Treasury yield as of April 2nd, 2026, was approximately 4.31% according to Trading Economics, elevated but not in crisis territory. The MOVE index was approximately 115 as of late March, according to Hayes' own public commentary, confirmed by the StockTwits reporting. Brent crude had traded above $109 per barrel at one point during the March 18th Fed meeting week, according to CNBC's live coverage. None of these numbers represent a crisis. All of them represent a trajectory that Hayes is monitoring. He is not saying the clock has struck midnight. He is saying the clock is running. There's a specific additional catalyst that neither Hayes nor most market analysts have fully priced into their frameworks: the Federal Reserve Chair transition itself. If Kevin Warsh is confirmed and takes the helm in late May, he inherits an economy under oil shock, a bond market under pressure, a fiscal deficit expanding due to war spending, and a political environment in which the Trump administration has been vocal about its desire for lower interest rates. Warsh's reputation as a hawk could actually make him more willing to cut in this specific environment, because a pivot by a perceived hawk carries more credibility as an anti-inflation signal than a pivot by a dove like Powell. Hayes' explicit prediction in his iOS warfare framework is that the combination of fiscal pressure and bond market stress will force any Fed chair, regardless of ideological orientation, to eventually ease. If Warsh wants to establish credibility and avoid a bond market crisis in his first 100 days, the historical precedent suggests he will follow the same pattern as every Fed chair before him: prioritize functioning Treasury markets over ideological consistency. The iOS warfare framework is intellectually serious, historically grounded, and constructed with genuine analytical rigor. It is also the work of a man who has publicly failed to predict price and timing with acceptable accuracy in 16 of his last 20 documented calls, who has a direct financial interest in Bitcoin appreciation, and who runs an investment fund that benefits from institutional interest in the asset class he is bullish on. Both things are simultaneously true. The framework deserves engagement on its merits, rather than dismissal based on the messenger, and it deserves honest assessment of its weaknesses, rather than uncritical acceptance based on the confidence with which it is presented. What Hayes gets demonstrably right. The 40-year Federal Reserve pattern is documented in primary sources that this channel verified independently. The FOMC transcripts he quotes are real. The rate cuts he cites after the Gulf War, after September 11th, and during the subsequent conflicts are documented historical fact. The move index mechanism he describes as the trigger for Fed intervention is real and is watched by every serious fixed income trader in the market. The Bitcoin M2 correlation is documented by multiple independent researchers at approximately 0.94 over the relevant historical window. The Reserve Management Purchases Program is real, documented in the New York Fed's own policy statement, and does represent a form of Fed balance sheet expansion, regardless of whether one agrees with Hayes or Wolf Street on whether it constitutes QE. The structural fiscal pressure from war, spending on top of $39 trillion in existing debt, is real. The transition to Kevin Warsh creates genuine uncertainty about Fed credibility. All of these are factual claims that this channel has verified against primary sources. What the bears get demonstrably right: the current inflation environment is structurally different from every prior episode Hayes cites as precedent. The 1990 Gulf War was 4 months long and ended before the inflationary shock became entrenched. The post-September 11th period was deflationary, not inflationary, when the Fed cut rates. The 2009 surge happened at the zero lower bound when the Fed had nothing to lose for more accommodation. None of those episodes confronted the Fed with the stagflationary combination of elevated oil prices and weakening labor markets simultaneously, the specific scenario that Morningstar, Oxford Economics, and Powell himself described as the distinguishing characteristic of the current crisis. Wolf Street's counter-analysis of RMP is technically credible, and this channel cannot dismiss it. The Proto's 20-call accuracy analysis shows Hayes fails on timing with overwhelming frequency. And the most important bear case is structural. A Fed that decides that its credibility as an inflation fighter is worth more than short-term growth support could choose to hold rates indefinitely, allow the recession that would follow to clear the inflationary pressure from the system, and emerge with a credible price stability mandate intact. Paul Volcker did exactly that from 1979 to 1982. It was the most painful economy in post-war American history, and it worked. The honest synthesis of both cases is this: Hayes has identified a real pattern and a real mechanism. The bear case is not that his pattern is fabricated, it is that this specific episode has characteristics that might break the pattern. The bull case is not that this time will definitely be like the last 4 times. It is that the structural forces pushing toward Fed accommodation are real, they are accumulating, and the move index provides a specific and observable signal for when those forces reach the threshold at which the pattern has historically activated. The question is not whether Hayes is right or wrong as a matter of ideological commitment. The question is whether you have a specific falsifiable trigger you're watching, a number on a publicly available index, a confirmation in the Fed's public communications, a shift in the dot plot, a rate cut decision. That would tell you the pattern is activated and the 10-week liquidity lag has begun to run. This channel does not give financial advice. This channel does not give price targets. What this channel gives is the architecture. And the architecture of the Hayes framework, stripped of its most extreme price projections and evaluated against the verified data, produces 3 specific publicly observable signals that this channel believes are worth monitoring in the next 90 days. Each of these signals is documented in primary sources, each is updated daily or weekly in free public data, and each represents a specific factual development that would confirm or refute the key claim in iOS warfare. Signal 1, the move index crosses 140. Hayes specified this level in his iOS warfare essay as the threshold above which he expects Treasury Secretary Bessent or the Federal Reserve to activate liquidity stabilizing measures. The index closed at approximately 115 on March 27th, according to Hayes's public StockTwits commentary. Its historical crisis levels, 250 in 2008, 170 in March 2020, 200 in March 2023, demonstrate that 140 is not an extreme reading. It is a stress reading. If the Iran conflict continues without resolution, if Brent oil remains above $100, and if Treasury issuance continues expanding to finance war spending, the move index trajectory points toward that level. If it crosses it and the Fed or Treasury does not intervene, Hayes' thesis is challenged. If it crosses it and intervention follows, the 10-week liquidity clock begins. Signal 2. The Fed's June 16th to 17th FOMC meeting produces a rate cut or an explicit expansion of the balance sheet. Goldman Sachs canceled its projected June cut when the Iran war began, moving its first expected cut to September. Morningstar noted that market expectations moved from 2 cuts to 0 to 1 during March. Powell's own March 18th press conference signal, 1 cut, conditional on inflation progress, gives the June meeting the earliest realistic window for the first post-war onset easing action. If June arrives with Brent above $95 and core PCE above 2.7%, the probability of a June cut collapses towards 0, and Hayes' thesis remains in its setup phase. If the Iran conflict reaches a ceasefire and oil returns toward $80, the June meeting becomes the activation event for the liquidity sequence Hayes has been describing for 6 months. This is the binary the iOS warfare framework is waiting on. Signal 3. The Federal Reserve's weekly balance sheet release shows the balance sheet growing. The Federal Reserve publishes its balance sheet every Thursday afternoon in a document called the H4.1 Statistical Release, available free at federalreserve.gov. It shows the total assets of the Federal Reserve System, which includes Treasury securities, agency securities, and other holdings. If the balance sheet begins growing week over week, through RMP expansion, through explicit QE, through new emergency programs, that is Hayes' confirmation signal regardless of what terminology the Fed uses to describe the purchases. The Wolf Street counterargument holds only if the balance sheet stays flat or continues declining. If it grows, Wolf Street's technical distinction between RMP and QE becomes irrelevant to Bitcoin markets, because Bitcoin responds to liquidity, not to the label on the instrument that creates it. This is the most direct signal in the framework and the easiest to verify. Check the H4.1. If it grows, the clock is running. Here is the complete synthesis. A man with a documented track record of failing on price and timing in 16 of 20 calls has written an essay arguing that a 40-year Federal Reserve pattern is about to repeat for the 5th time. That essay is built on real primary sources, a real mechanism, a real historical pattern, and a real current situation where the structural forces it describes are accumulating in real time. The bear case, that this episode's stagflationary characteristics break the historical pattern, is also real, is also supported by credible analysis, and deserves equal weight in any honest evaluation. The resolution of this uncertainty is not a matter of choosing which analyst you trust or which prediction sounds more confident. It is a matter of watching 3 specific, freely available daily updated data points: the MOVE Index, the June FOMC decision, and the weekly Fed balance sheet, and letting the market's own operational data tell you whether the pattern has activated. The people who understood the iOS warfare framework before it activated, who tracked the FOMC transcripts Hayes quoted, who understood why the MOVE Index matters, who knew what the RMP program meant for the balance sheet, those people are positioned before the consensus arrives. The consensus always arrives late. By the time CNBC is running the headline, Fed pivots as war costs force rate cuts, the 10-week liquidity clock will already have been running for weeks. By the time the headline reads, Bitcoin surges on Fed easing expectations, the asset will have already moved. This channel does not know if that is 6 weeks from now or 6 months from now or not at all. This channel knows that the architecture is real, the trigger is watchable, and the people who understand the sequence before it completes will be the people who were paying attention when the room was still quiet. Watch the MOVE Index. Watch the H4.1 balance sheet release every Thursday. Watch the June FOMC meeting. Those 3 signals, evaluated honestly against the framework and against the bear case, are everything you need to know whether Arthur Hayes is right about war liquidity printing. If he is right, if the pattern activates one more time, you already know what happens next. But before I go, I want to talk to you specifically. The average person watched less than 5 minutes of this video before clicking away for something easier. But you stayed for the whole investigation. You sat through the FOMC transcripts, the MOVE Index mechanics, and the H4.1 balance sheet logic. That means you're not just a trader, you're a researcher. You have the attention span that Wall Street and the central banks count on you not having. You are officially part of the 1% who actually knows how the machine works behind the curtain. If you made it to this final second, I want you to leave a comment with these 4 words: the math never sleeps. I read every single one of those, because those are the people this channel was built for. Hit the like button and subscribe if you want me to keep going deeper on this. Stay vigilant. I'll see you in the next one. I see the diamond.